We had seen the devastation of the original Big Short when basically everyone was suggesting that the financial markets were going higher, the real estate market was healthy, and the derivatives were never even discussed. Few were warning of what was coming. Today, it seems almost too obvious, with massive retail bankruptcies taking place and will continue to grow in 2020 and beyond. The derivatives behind them will have to fall as well. Will the Fed do what they did with the garbage mortgage-backed securities and buy as much of them as they can forever? You came here for the truth, so let me unveil that for you. Today we are going to look at the Big Short. They're calling it 3.0. I want to show you what's going on with that. I want to take a look at what's happening with the retail bankruptcies. Going to give you some charts on this. I've got information coming from Bloomberg, from other sources as well. We're going to look at what the Federal Reserve has been saying, a lot of information there. You know what their policy has been. I covered in the previous video, but of course it's been all over the news. They are going to a place in which, according to some, they will not be able to raise interest rates for a period of 40 plus years. I don't know what's going to happen over the next 40 years, but I can tell you that this is where they are heading. Low interest rates for as long as possible. They tell you that everything's okay, and then they keep interest rates at historically low levels. Doesn't make any sense. Anyway, let's get into it. Retail bankruptcies will push mid-range malls over the edge. They talk about here the C-class malls, the D-class malls. Those ones are more likely to actually disappear, but it's those that they call B-class malls. And these ones are the questionable malls that have some of the higher-end stores. They have some of those retail chains. They've got the mom and pops as well. As soon as some of these anchor stores disappear, you know what happens. Most Americans have never been to Crystal Mall, nestled between a standalone Target and a sprawling Home Depot on a nondescript 4-lane turnpike that could be anywhere, and that's the point. The 2-level shopping center in Connecticut, with its disappearing department stores, bankrupt retailers, and landlords trying to prop up its own tenants, could be just about any mall in the US. And this is something that I've been talking about because it could be anywhere. That situation could affect anyone, and you have the same sort of thing happening. All of these anchor stores start to disappear. They're closing down, they're liquidating their inventory, and everybody else is affected down the line. It's not as if one store goes away and then they just have to find a new tenant. Maybe it'll be Amazon. They turn that into a fulfillment center. It doesn't work like that. Of course, there is a serious problem here, and we know, I will say that straight up right now, the amount of retail in the United States is ridiculous. There's way too much of it. But let me explain the fact that there are so many people working in retail. So if all of a sudden these people do not have a job, do not have a place to go, there's going to be a ripple effect. So we've got this problem on so many levels. We're talking about an employment problem, an employment crisis, really, when you look at it, but also the debt and the derivatives that connect it all. I need to stress how important this is. The derivatives are essential to understand, and yet most of the time they never even talk about it. The alternative news doesn't talk about it because it's not cool, doesn't get the hits, and of course the mainstream doesn't even know what that is. Retail bankruptcies, a record number of stores have filed. I'm just going to show you this. Font is probably too small for a lot of people to see, but this is over the last year and what's been happening. So this right here is August 2019, shows you up until the present, and you see apparel and footwear, department stores, other retail. It breaks it down. JCPenney's in here and other names that you may recognize. I've covered this as it had happened, but this just kind of lays it out, and you could see over the period of 1 year how many big businesses are going down, they're going bankrupt, they're closing down their locations, liquidating whatever they can, and you know what happens along with that, the ripple effect. But this is the big one right now. This is the one that people need to be keeping their eyes on and think about what this means. Empty hotels might just be the next big short for hedge funds. Investors seemingly scooping up protection on CMBX9 index. Remember, I talked about the 6 previously. I've highlighted, I think, the 10 or the 11 previously as well. But this one is talking about the 9. Strategy popular amid bets bets against commercial real estate. And if you look at how they're all broken down, it'll give you a better idea of what that all means. Essentially, these different indexes will have all of the different debt that's related to retail, or maybe it's multifamily and so on. But in this case here, we're looking specifically at the hotels. That's the big one. Hedge funds and other short sellers are beginning to set their sights on a U.S. credit derivatives index with outsized exposure to hotel debt as the situation here in 2020 sinks the hospitality industry into distress. The firms are starting to build up wagers against the synthetic index known as CMBX9, shifting attention from a high-profile bet against America's challenged malls. The shift, which market participants say is beginning to show up in some trading flows, comes as delinquency on hospitality property loans surge and even begin to exceed those in retail. Remember what I covered not that long ago, just a few days ago, I think, 25% of these hotels have not been paying up on their mortgage. That's huge. And that obviously has spurred some of this activity that we're seeing in the derivatives. In the last month, there has been more selling pressure on the CMBX9 than any of the other ones. And essentially saying that because they have such exposure, the 9 has such exposure to the hotels, they see this as an opportunity. There's the chart that corresponds to it. High hotel concentration, CMBX9 plummeted in March and never fully recovered. I will give you updates on this. It is really important. Definitely stay tuned. Let's be serious. Let's be frank. We were told time and time again, these problems are temporary. Everything's going to be fixed. Everything's going to be fine. We're not going to lay anybody off. We're not going to fire anybody. We're going to furlough people. That's right. Furry is nice and cute, like a fluffy kitten. Sounds a lot better, right? MGM Resorts lays off 18,000 previously furloughed employees. Call it what it is. They got kicked to the curb. They don't have a paycheck anymore. They do not have employment. This is what's going on right now today. One example, but there are more and more and more. Coca-Cola will eliminate thousands of jobs in the US and abroad. It's the latest in a series of cuts that have reduced their workforce by roughly 100,000 in the past 8 years, bringing its headcount to about 60,000 at the start of 2020. So this has been a trend for a period of time, but now that's accelerating. Coca-Cola said it was offering buyouts to 4,000 of its employees in the US and Canada for the first phase of the job reductions. The company avoided using the word layoffs, instead calling the job cuts voluntary or involuntary separations. Sounds kind of silly, but that's what they're doing. A lot of the companies are doing this. In fact, they don't want news articles written about them saying they're laying people off because that sounds bad. Call it a furry furlough kitten, call it a involuntary separation. The person doesn't have a paycheck. That's all that matters. Fed's Bullard says the recession is over, but rates will stay low for a long time. That's right, that sounds normal to me. The recession's over, we have a V-shaped recovery, but we're going to leave interest rates at record low for 40 years if necessary. We are going to pump money into the system in every single direction, and the government is going to provide fiscal support, pumping money directly to people, as well as public works projects and everything else. Something is completely disconnected there, and yet very few of us are actually understanding it. I'm glad you're here because you and I both know what's going on. Opposite end of the spectrum, you have seen how the performance of tech stocks has looked more exaggerated than the dot-com bubble in many ways. US tech stocks are now worth more than the entire European stock market. That's insane. The entire thing, just the tech stocks, are worth more than all of Europe's stock market. Now you could say that this is a reason for it, that's the reason for it. It's excessive. There's so much money from all over the world funneling in. Plus, the number one buyer of these tech stocks are the companies themselves. You've got some serious things going on today with corporate debt. It's excessive, and it's got a lot to do with what the central banks are up to. The former Atlanta Fed president said that a double dip in the US economy is still possible. Of course, he put a caveat in there. He wasn't saying that this is going to happen, but it's a worst case scenario. We have to see what's going to happen. I don't know how this is going to unfold, but I can tell you right now, we have to separate the economy from the stock market. The economy, number one, has not recovered. Let's be very clear about that. When they talk about a double dip, we still haven't gotten to a point where there's recovery so that we can fall back down again. The stock market, they have actually accelerated beyond where they were previously. The losses have been wiped out. But now we're generalizing because you look at the majority of stocks and they have not performed very well. They are still taking a beating. Look at how many of those big names, ExxonMobil for one, that was booted out of the Dow Jones. I mean, things are really changing today here in 2020. About 61 million Americans have stopped commuting. Think about how crazy that is. How many people that are affected by what's happening today, how these changes will impact all of the different businesses, sectors, and industries that go into commuting. A simple thing. They actually go into some of the details here in this article, but think about it. If the person doesn't need two cars in the family any longer, they can get rid of one, they can sell off one, they can maybe take public transit when needed, maybe they'll walk, maybe they'll take a bike. I know that bicycles have been very hot right now. We'll see what happens come winter time, but there are major changes. I mean, imagine all of those people, they're not filling up the gas. They don't need the insurance anymore. They don't need those repairs on their vehicle to happen. Go all the way down the line. Think of that, all the way down and down and down. How many jobs are going to be affected by it? Essentially, less economic activity. So when we look at the GDP, previously it was growing at, let's say, this rate here, and then we have this major fallout, and they're suggesting it's going to come right back up and continue to grow again. I've drawn this many times before, but the way I see it is that instead of being able to go up in this way, we're going to see this long and drawn out pattern that never gets back to that growth, which would be consistent with the previous recessions, except I think on a more excessive level. And then we have this. Cashierless stores are popping up at gas stations, stadiums, and even Dunkin'. The concept popularized by Amazon Go may be getting a lot bigger. I do think that this will happen. I do think that this will hit the next level and it'll start to be more widespread. People don't want to interact with other humans. They would rather see a tablet, computer, their phone. Now with this issue in 2020, people are worried, they're concerned. Whether or not it's better, that's somebody's opinion. All I'm saying is this is the direction a lot of companies are going. Whether it's going to be to get your coffee, maybe to flip your burgers, whatever the situation is, we definitely see a rush to go into this automated system, robotics, and so on. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn how to sell stuff online, I'm talking about e-commerce, you can learn for free at my website right here, theamazongps.com. Do you want to understand the financial system? In these two books, I break it all down, but I make it so easy to understand. Check it out at the link in the description if you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? It's really detailed. There's so much info. Definitely watch it. Click it. I'll see you there.